The Isaac Newton Paradox. Sir Isaac Newton, one of history's sharpest minds, lost a fortune roughly $3 million in today's money in the South Sea Bubble of 1720. The man who charted celestial mechanics could not chart the madness of people. This paradox illuminates William Bernstein's The Four Pillars of Investing. Investment success is not an IQ test, but a battle against human nature. This is 60 Minutes Book Wisdom. Today, we unlock the inverse correlation of IQ and investment success. You'll learn how intellectual brilliance can be a financial liability, and how to leverage this for tangible ROI. Bernstein rejects chasing market aces. He equates successful investing to winning at amateur tennis. Not by daring risky shots, but by minimizing unforced errors. As he quotes Charles Ellis in the chapter on portfolio construction, the best way to win a game with your friends is to simply make sure you safely return the ball each time. In other words, in amateur tennis, you don't win so much as you avoid losing, hence the title of Ellis's article, Winning the Loser's Game. The Unforced Error Minimization Protocol. Rigorously avoid excessive fees, market timing, and trend chasing. In today's AI-driven, algorithmic markets, daily outsmarting is financially futile. Newton's downfall confirms. High IQ often hinders investment success. Minds trained for complex patterns struggle with the market's randomness and psychological distortions. Bernstein argues in The Market is Smarter Than You Are that markets are swayed more by collective human behavior than pure logic. This is clear in today's crypto and speculative tech bubbles, where smart investors often overthink or overleverage. As Bernstein states in his summary on misbehavior, the investor's chief problem, and even his worst enemy, is likely to be himself. The cognitive bias awareness protocol demands actively countering overconfidence, recency bias, and herd mentality. Your primal brain is unsuited for optimal capital allocation. Now, a Steelman. Couldn't advanced AI find an edge? One might argue AI discerns patterns humans miss, enabling a new, smart investing era. Quant funds suggest this. However, Bernstein's critical thinking on market behavior reveals all known information is quickly priced in. Any AI edge is swiftly arbitraged away. The market's smartness is its collective processing, not a solvable puzzle. True ROI isn't in complex AI alpha chasing, but recognizing that costs almost always erode marginal gains. To shield your portfolio from intellectual hubris, Bernstein insists on separating calculation from speculation. Calculation is true investing. Assets with predictable income streams, stock dividends, bond interest, real estate rents. Speculation is buying on the mere hope someone else will pay more, common in today's meme stocks or NFTs, which lack underlying income. As Bernstein articulates in his analysis of value and income streams, only an income-producing possession, such as a stock, bond, or working piece of real estate, is a true investment. The valuation anchor protocol is simple. Demand an underlying income stream. If you can't identify its discounted present value, you're speculating. In 2024 to 2025, fueled by the attention economy, speculation rarely builds sustainable wealth. Newton failed because he lacked a fundamental anchor for valuation. That anchor is a simple equation we reveal in the next section. The Gordon equation anchor. In 1929, Irving Fisher, arguably the most celebrated economist of his era, famously declared stocks had reached a permanently high plateau, a pronouncement made mere weeks before the most catastrophic market crash in history. Fisher, despite his brilliance, failed to heed a fundamental truth that William Bernstein, in The Four Pillars of Investing, places at the very core of rational investment, the mathematical reality of income streams. He failed because he focused on ephemeral sentiment, not enduring substance. Bernstein introduces us to a crucial analytical tool, what we might call the Gordon Protocol. In the chapter dedicated to measuring market returns, he outlines the Gordon equation. Expected return equals dividend yield plus dividend growth. This isn't merely an academic formula. It's the unseen hand of financial gravity, an immutable law that anchors all true value. For any asset, whether a legacy blue-chip stock, a venture in the dizzying heights of AI innovation, or even a nascent crypto enterprise that eventually generates an income stream, its long-term return is fundamentally tethered to two quantifiable factors: the income it currently throws off and the sustainable rate at which that income can grow. This protocol serves as an indispensable audit for any investment promise. Consider the valuations of many high-flying tech firms today, or the speculative fervor around unproven digital tokens in our attention economy. If an asset is promising returns exceeding, say, 10 to 12% indefinitely, without a clear, demonstrable path to a corresponding dividend yield and sustainable growth, then alarm bells should be deafening. It's either a fleeting bubble, a Ponzi scheme, or a profound delusion. As Bernstein points out in his analysis of valuation, the value of a stock or a bond is simply the present value of its future income stream. Notice he doesn't say future price appreciation. The discerning investor ignores price appreciation forecasts, focusing solely on income stream mechanics. Many investors today, swept up in narratives of AI breakthroughs or remote work revolutions, are fixated on price appreciation forecasts. They chase the chart, the media hype, the next big thing, convinced this time is different. But the wise strategist, operating with a Mungeresque ROI lens, strips away this noise. They employ the Gordon Protocol. They ask, what is the current income stream? What is the sustainable growth of that income stream? Anything else is pure speculation, a wager on collective delusion, especially potent in an era where attention itself is a currency. Now, a Steelman argument might arise, but what about growth stocks? What about companies that reinvest all their earnings and don't pay dividends like so many promising AI startups? Aren't they exceptions to this rule, delivering exponential returns without direct income? Certainly, the market does reward companies that successfully reinvest capital at high rates, driving future earnings growth. But even here, the growth must eventually translate into future income streams for shareholders, whether through eventual dividends, strategic buybacks that increase per share value, or a profitable acquisition. The Gordon Protocol, in its essence, is a reality check on the sustainability of that growth, not a denial of it. It forces us to ask if the rate of projected growth is mathematically plausible in the long run, challenging the new paradigm fallacy so prevalent in every bubble. As Bernstein eloquently reminds us, in the context of market exuberance, trees don't grow to the sky. The Gordon equation becomes your internal due diligence mechanism, your financial GPS, always pointing to the true north of intrinsic value. It's the sober mathematical reality that cuts through the speculative frenzy and the siren song of short-term gains. In the concluding chapter, Bernstein reiterates this foundational principle. The long-term return of stock markets can be estimated by combining per-share earnings growth with dividend yield, whereas bond returns align with their yield. This is the core protocol, an anchor in the storm of market sentiment. Once you know the math, you realize most stock pickers are guessing. But surely the experts know better? The data says otherwise. The cowls counter intuition. In the relentless hum of the modern market, amidst the dizzying surge of AI-driven trading algorithms and the clamor of crypto gurus promising untold riches, there remains a primal human yearning. The desire for an oracle, a seer who can gaze into the chaotic future of finance and reveal its secrets. We are bombarded daily with newsletters, podcasts, and data feeds, each vying for our attention, each claiming to possess the elusive key to market outperformance. But what if this entire quest for the market whisperer is a fool's errand? The brilliant, if perhaps underappreciated, Alfred Cowles III, back in the 1930s, subjected this very premise to rigorous statistical scrutiny. He didn't just theorize. He forensically dissected the performance of the era's most celebrated financial forecasters and newsletters. His conclusion was devastating, cutting through the mystique of market expertise like a surgeon's scalpel. In his seminal work, he fundamentally challenged the prevailing belief in professional stock picking. As William Bernstein reveals in The 4 Pillars of Investing, Cowell's findings were stark. The ability of these supposed titans to predict market movements was no better than random chance. In essence, tossing a dart at a stock list was as effective as paying for a guru's wisdom. This truth gave birth to what became known as the efficient market hypothesis. The market, in its collective wisdom, has already factored in all available information into asset prices. Trying to consistently outperform it is like trying to consistently beat the house in a casino where the odds are perfectly balanced. Consider this. The financial market is an immense, dynamic ocean, teeming with countless currents, tides, and marine life. Every analyst, every news channel, every AI algorithm is a tiny fishing boat, each deploying its unique net. The collective effort of all these boats means that any significant school of fish is instantly discovered and dispersed. Trying to consistently find an untouched school is a monumental, often futile, effort. Cowell's demonstrated that relying on any single fishing report is a pathway to frustration. This leads us directly to the Cowell's filter protocol. Immediately dismiss any financial newsletter, market prediction, or AI-generated forecast that promises to tell you what stocks to pick or when to trade. These are, by the very nature of market efficiency, statistically unreliable. In The Market is Smarter Than You Are chapter, Bernstein doesn't pull punches. As he puts it, Cowell's found that the very best newsletter results could easily be obtained by random choice. This isn't just a critique. It's a liberation from the endless noise. But if we can't beat the market, what can we do? We shift our entire strategic calculus. Instead of chasing elusive alpha, the mythical extra return generated by skill, we embrace beta, the market return itself. Our goal is no longer to be a star stock picker, but a shrewd owner of the entire ocean. The focus moves from speculation to systematic participation. This brings us to the 3-pillar protocol for market acceptance. 1. Embrace beta as the goal. Your primary objective is to capture the overall market's return, not to outweed it. This means broad diversification, owning a slice of everything, minimizing the risk of being wrong about any single investment. 2. Relentless cost reduction. If market outperformance is largely random after costs, then every dollar spent on fees, commissions, or high-expense funds is a direct reduction of your return. Bernstein emphasizes this in his analysis of mutual funds, highlighting that the average investor receives a net return equal to the market's minus expenses. In an era of near-zero fee index funds and ETFs, paying active management fees is often a self-inflicted wound. This means scrutinizing every basis point. 3. Prioritize asset allocation over stock selection. Since individual stock picking is futile, our energy is far better spent on what we can control, how we allocate our capital across different asset classes, stocks, bonds, real estate. In the Perfect Portfolio chapter, Bernstein argues that asset allocation is the only factor affecting your investment risk and return that you can control. This is the true leverage point for individual investors. So, the conventional wisdom that successful investing hinges on finding the smartest guru, the hottest stock, the innovation trap. The year is 1845. Britain is gripped by a fever. Not gold, but iron. Railways are tearing through the countryside, promising unprecedented speed, connection, and prosperity. Investors, from lords to laborers, pour their life savings into new railway companies, fueled by the vision of a revolutionized nation. Yet, within a few short years, this boom collapses, wiping out fortunes and leaving a trail of bankruptcies. The paradox? Railways absolutely did revolutionize the economy. So why did their early investors often end up destitute? This is the insidious mechanism of the innovation trap. William J. Bernstein, in his seminal work, forces us to confront a fundamental economic truth that runs counter to our intuition. Economic growth and investment return, especially for innovators, are often inversely correlated. We naturally assume that if a technology changes the world, its creators must reap extraordinary returns. But history, as Bernstein meticulously details, tells a different story. This historical pattern echoes loudly in our current era. Think about the explosive growth in AI, blockchain, or new remote work platforms. The media is ablaze with new era narratives, promising transformative wealth for those who back the next big thing. But as rational capital allocators, we must ask, are we witnessing genuine, sustainable investment opportunities, or are we falling into an age-old trap, just with shinier new technologies? Now, some might argue, but isn't this precisely where generational wealth is built? Look at the early investors in Google, Amazon, or Nvidia. You have to get in early on disruptive technology. And they have a point. The outliers are indeed spectacular. But focusing on these lottery tickets blinds us to the vast graveyard of innovation that precedes them. The reality, as Bernstein illustrates, is that for every Google, there are 1,000 petcoms, countless bankrupt blockchain projects, or AI startups that consume capital voraciously before fading into obscurity. Bernstein dissects this phenomenon through stark historical examples. In his analysis of market manias, he brings us back to the British railway mania of the 1840s. The railways revolutionized the economy and society, yet the vast majority of investors were wiped out due to fierce overcompetition, capital dilution, and an unsustainable expansion of infrastructure. The same pattern repeated with the 18th century canal mania, the Dutch tulip mania, and even the dot-com bubble of the late 1990s, which, in his chapter on Tops, A History of Manias, he notes exemplifies the same patterns of speculative investing seen in previous decades, marked by technological obsession, accessible credit, generational forgetfulness, and mispricing risks. As Bernstein puts it bluntly in the same chapter, the great engine of stock returns is the rate of technological progress, not its absolute level. This is a critical distinction. Society benefits immensely from these innovations, but the investors funding the cutting edge often bear the brunt of capital destruction. The consumer wins, the innovator creates, but the capital allocator often loses. Consider the innovation landscape not as a fertile garden where every seed sprouts into a mighty tree, but as a colossal industrial furnace. This furnace consumes immense amounts of capital, fueling research, development, and competition, and, over time, it generates immense societal value. New industries, higher productivity, transformative products. But the investors who shovel capital directly into the furnace, especially at its hottest and most hyped, are often burned. Their capital is incinerated, fueling the fire for others to eventually benefit. So, what's the protocol for navigating this furnace? The simple yet counterintuitive, by the shovels, not the gold mine. Or, to extend our metaphor, don't invest in the furnace itself, or the companies perpetually shoveling coal into it. In the Minsky cycle, the financial markets have a peculiar amnesia. Every few decades, we witness a grand spectacle. A groundbreaking innovation promises to transform society, capital floods in, and suddenly, logic takes a back seat to FOMO. What's often forgotten in this frenzied pursuit of future riches is a stark truth. The greatest technological leaps are frequently a graveyard for early investor capital. It's a recurring template of boom and bust, and William J. Bernstein, in The 4 Pillars of Investing, brilliantly dissects this phenomenon, offering us a map to navigate what Hyman Minsky famously termed the financial instability hypothesis. Minsky's cycle, as illuminated by Bernstein, isn't just history. It's a predictive algorithm, a four-stage process that lays bare the mechanics of speculative manias. Ignore it at your peril, for as Bernstein states in the chapter covering historical manias, those who cannot remember the past are condemned to repeat it. Stage 1. The displacement, the new gold rush. Every bubble begins with a displacement, a genuinely transformative innovation. Think of the 17th century diving bell technology, the 18th century canal building, the 1840s railway boom, or the dawn of radio in the 1920s. Today, we see this displacement in the explosive growth of AI, the promise of Web 3, and the shifting paradigms of remote work infrastructure. These aren't trivial advancements. They are foundational. And here's the crucial economic paradox. New technologies, while beneficial to users and society, often deliver poor returns to early investors. It's akin to a new gold rush where the prospectors lose their shirts, but the pickaxe sellers get rich. As Bernstein highlights when discussing the marine chronometer, the financial rewards often go to effective adopters, not the inventors. Early investment here isn't about ROI. It's often an R&D subsidy for society. Stage 2. Credit expansion, the inflatable safety net. The true accelerant to a displacement is easy credit, or as Minsky terms it, liquidity. When money becomes too cheap, too accessible, it inflates an illusion of safety. This isn't just banks lending more. It's the societal perception that risk has vanished, allowing capital to flow into increasingly speculative ventures. The credit thermometer protocol is simple: watch the cost of money. Is it practically free? Are lending standards loosening? If so, the market isn't just growing, it's expanding on borrowed confidence. This easy liquidity fueled the South Sea Company's expansion in the 18th century, allowed excessive margin buying before the 1929 crash, and bankrolled countless dot-com startups with no viable path to profitability. The ROI calculation shifts from fundamental earnings to the expectation of greater fools, paying a higher price, irrespective of underlying value. Stage 3. Euphoria, the siren song of, this time it's different. With easy credit, the masses enter, driven by what Bernstein identified as the Thaler anomaly. Picture this. A blinding snowstorm descends upon a nearly empty basketball arena. The game is unwatchable, yet Richard Thaler, the behavioral economist, observed that many spectators remained. Why? The sunk cost fallacy, a powerful psychological trap. Bernstein, drawing from Thaler and the foundational work of Kahneman and Tversky, unpacks this precise human irrationality to explain why investors consistently sabotage their own wealth, often selling at the absolute bottom. They feel the sting of loss with twice the intensity of the joy of gain, abandoning strategic plans when discipline is paramount. This psychological chasm between rational economic models and actual human behavior is amplified in our 2024 to 2025 attention economy. With every stock price alert, every crypto chart flicker, every real-time news headline on your wrist, we are constantly force-fed ephemeral data, directly fueling our myopic loss aversion. It's like trying to steer a supertanker by constantly watching the waves around its bow, instead of the distant horizon and your charted course. Constant microcorrections based on fleeting data guarantee you'll drift, burn excess fuel, and likely never reach your destination efficiently. To cut through this self-sabotage, we adopt a strategic protocol. First, to combat myopic loss aversion, implement the Thaler protocol. Check your portfolio a maximum of once per year. As Benjamin Graham, quoted by Bernstein, sagely declared in Chapter 7, the investor's chief problem, and even his worst enemy, is likely to be himself. Frequent monitoring, in this context, is not vigilance. It is a direct pathway to emotional reactivity that corrodes long-term returns. Next, reframe volatility. In a downturn, your mind screams, loss. But from a rational, economic perspective, a market drop is simply a future income sale. Every decline means you can acquire future income streams, whether dividends from stocks or interest from bonds, at a cheaper price. Bernstein implicitly urges us to adopt this Mungeresque perspective. Invest when others are fearful, when the market offers its goods at a discount. Finally, to neutralize the insidious recency bias, adopt the 50-year filter protocol. When one-year performance data looks terrifying, deliberately seek out 50-year historical returns. The market's short-term gyrations are overwhelmingly coincidental, not predictive. Bernstein, in his analysis of market patterns, cautions that most patterns in stock market behavior are coincidental. Attempting to predict market movements through historical data is generally ineffective. Recency bias blinds us to the long-term upward trajectory of productive assets. By applying the 50-year filter, you force your brain to contextualize current noise within the vast, steady signal of compounding returns. This isn't about ignoring risk. It's about discerning actual risk from emotional panic. The Chernovia parasite. Charles Merrill, founder of the legendary Merrill Lynch, dreamed of financial advisors prioritizing clients, paid by salary to remove commission incentives. His vision: a financial sanctuary, not a sales arena. Yet, as Bernstein details in his chapter on the investment business, Merrill's dream was shattered. Future leadership under Donald Reagan reinstated commissions, transforming brokers into what Bernstein implies are sales wolves, turning client accounts into profit-feeding frenzies. This tragic pivot birthed Chernovia, a landscape where the broker's yacht is often paid for by the client's losses. The agency problem is stark. Your broker's true interest is not your optimal return, but their optimal income. It's a conflict as old as commerce, amplified by today's attention economy, where every expert vies for your trust. Your broker is not your buddy. Bernstein reveals that, unlike doctors or lawyers, brokers lack a fiduciary duty. They're legally bound only to recommend suitable products, not necessarily optimal for you. This distinction is paramount. Your concrete protocol is the fiduciary test. Never hire an advisor who isn't a fee-only fiduciary. This is the absolute minimum for alignment. Anything less, and you enter Chernovia unprotected. Consider the allure of full-service brokers. In an era of information overload, especially with complex assets like crypto or nascent AI ventures, a dedicated professional seems appealing. But as Bernstein starkly observes, a broker with a clientele full of contented customers was, and is, a broker who will soon be looking for a new job. Brokers need trades to make money. This is their brutal ROI. Their service often stems from churning your account, excessive buying and selling to generate commissions. This doesn't optimize your long-term ROI. It optimizes theirs. Then, there's the seductive promise of wrap accounts, a single fee covering all commissions and management. Yet, Bernstein warns in his Q&A for your broker is not your buddy. These can be a red flag for hidden fee layering, a sophisticated way to extract wealth, often leading to high costs for clients. The protocol is clear. Assume any full-service or wrap account offering optimizes their profit, not yours. **** demand absolute transparency on every cost. If it's not fee-only fiduciary, walk away. The ROI on trust is infinite. The cost of misplaced trust, catastrophic. This message is not for the investor seeking entertainment over exponential growth, who chases get-rich-quick schemes in volatile crypto, or delegates financial sovereignty blindly. For the rational investor, ROI means minimizing leakage, understanding where capital actually goes. The digital age, with its endless influencers and gurus peddling opaque products, has merely digitized and scaled Chernovia. The parasite has adapted. Brokers take your money via fees. The media takes your money via bad advice. Let's expose the financial pornography industry. The financial pornography filter. We live in an age awash with information, a relentless deluge promising instant insight into everything from decentralized finance to the next AI behemoth. Yet, paradoxically, as the volume of financial news explodes across every screen and feed, the signal-to-noise ratio plummets, leaving us more confused than enlightened, often leading to decisions driven by fear or FOMO rather than fundamental value. William Bernstein, with surgical precision, dissects this modern affliction. He urges us to apply a critical lens, an explicit filter, to the constant stream of market chatter. He aligns with the astute observation from financial commentator Jane Bryant Quinn, who, as Bernstein notes in his analysis of financial journalism, wisely labels much of it as simply financial pornography. This isn't mere hyperbole. It's a stark metaphor. Like pornography, this content is designed for instantaneous gratification and arousal, emotional in this case, rather than intellectual. It's sensational, stimulating, and relentlessly optimized for engagement. As Bernstein quotes Lily Tomlin in the chapter on Oliver Stone Meets Wall Street, "No matter how cynical you become, it's never enough to keep up. This content lacks, as Quinn puts it, genuine informative value. It's a quick fix that leaves you poorer in discernment, much like the attention economy's entire business model." Now, one might steelman the counterargument. Surely, in an era of unprecedented global connectivity and algorithmic trading, real-time news from platforms like Bloomberg or CNBC, or the latest insights from a trending crypto analyst on X, offers an indispensable edge. To disengage, some would argue, is to blindly navigate a market landscape radically transformed by AI-driven innovation and lightning-fast information flows, missing critical shifts that could make or break a portfolio. Yet, Bernstein systematically dismantles this premise. The very incentives driving this media machine are misaligned with your long-term financial health. Think about the star fund manager phenomenon, so often plastered across magazine covers or championed in breathless segments. The historical record, as meticulously analyzed in the chapter discussing market efficiency, reveals a harsh truth. Today's cover story is, with statistical certainty, tomorrow's underperformer. These managers, lauded for fleeting success, often benefit from luck, not repeatable skill. Their brief moment in the sun generates hype, attracting capital just in time for their performance to revert to the mean, leaving late-arriving investors holding the bag. We saw this vividly during the go-go market era and overvaluation in the 1960s and 70s, where the financial press touted Nifty 50 stocks as one-decision buys. Investors who succumbed to that media-fueled euphoria, betting on perpetual growth rather than underlying value, suffered significant losses when the bubble inevitably burst. The media feeds off this cycle, managers crave visibility, and journalists crave exciting narratives, often neglecting the dull but profound truth of market fundamentals. So what's the pragmatic response? The protocol is clear. Replace the endless scroll of financial news and opinion with a curated regimen of foundational knowledge. In the chapter Oliver Stone Meets Wall Street, Bernstein suggests that genuine financial knowledge stems from historical context and market principles, not chasing fads. Therefore, actively disengage from the real-time financial noise. Instead of constantly monitoring CNBC, Bloomberg, or the latest YouTube crypto guru promising 100x returns on an obscure token, immerse yourself in the robust historical data and timeless investment principles documented in books. This isn't about ignoring the world, but about filtering it through a rational lens. Your ROI isn't found in predicting the next microtrend that an AI algorithm might exploit for a fraction of a second, but in understanding the macroeconomic currents that dictate true wealth accumulation over decades. This financial pornography filter protocol is essential for shielding your portfolio from the psychological traps of the attention economy, which monetizes your anxiety and herd instincts. So if we keep the 91.5% solution, the digital age, with its relentless fire hose of real-time data and speculative narratives, from AI stock surges to fleeting crypto memecoins, has tricked many into believing that financial success hinges on tactical brilliance. We're fed a constant stream of expert takes, newfangled indicators, and the seductive siren song of market timing. But what if this entire premise is a misdirection, a grand illusion that distracts us from the true levers of wealth creation? Welcome to the 91.5% solution. The truth, stark and almost offensively simple, was unveiled in a landmark 1986 study by Brinson, Hood, and Biebauer. They dissected the performance of large pension funds, institutions with vast resources and legions of supposedly brilliant minds. Their finding was a seismic shock to conventional wisdom. 91.5% of the variation in returns was determined by asset allocation. Not by individual stock selection, not by market timing, but by the fundamental, foundational mix of broad asset classes like stocks, bonds, and foreign equities. This single insight renders decades of daily market commentary and guru predictions largely irrelevant to long-term outcomes. Think of building your financial future not as a frantic daily sprint, but as constructing a fortress against the unpredictable weather of the market. As William Bernstein, our guide, wisely states in his work, building a portfolio is akin to constructing a house, where various investment vehicles serve as the construction materials. Your asset allocation is the blueprint, the very foundation of this structure. Are you building with sturdy bricks of diversified global equities? Or are you hoping to stand on a house of cards made of single-stock lottery tickets? The robustness of your foundation dictates its resilience. Now, I can already hear the seasoned traders and the crypto evangelists. They'll steelman the counter-argument. But surely, the skill to pick the next NVIDIA, the foresight to sell before a crash, that's where the real alpha is found. Look at the legendary investors, the overnight millionaires in decentralized finance. They weren't building boring policy portfolios. And indeed, the allure is powerful. The dopamine hit from a lucky trade, the media narrative of the genius stock picker, it's all incredibly compelling in our attention economy. Yet, this perspective fundamentally misinterprets the data. Bernstein, in his deep dive into market history and psychology, reveals the inconvenient truth. He illustrates it vividly with the analogy of randomovia, a fictional land where chimpanzees, by random dart throwing, achieve returns comparable to professional fund managers. The apparent skill of a few market wizards is statistically an anomaly, often indistinguishable from sheer luck over the long haul. As Bernstein puts it, since you cannot successfully time the market or select individual stocks, asset allocation should be the major focus of your investment strategy, because it is the only factor affecting your investment risk and return that you can control. In other words, chasing individual stocks or attempting to time the market is like trying to manually adjust the climate inside a vast, self-regulating biosphere. It's a futile, energy-draining exercise that distracts from ensuring the biosphere itself is built correctly. So, what is the protocol for leveraging this 91.5% solution? It's elegantly simple, yet profoundly difficult for human nature to embrace. First, focus 90% of your intellectual and emotional effort on asset allocation. This means meticulously deciding your strategic mix of broad market segments. How much in domestic stocks, how much in international stocks, and what proportion in safe, short-term bonds. This is your macro-level decision, the master control panel of your financial future. It's about understanding your true risk tolerance, not your greed or fear of the moment. Second, dedicate 10% of your effort to cost reduction. High fees are insidious. They are the barnacles on the hull of your financial ship, slowing you down year after year. As Bernstein and other financial giants like Jack Bogle, who famously built Vanguard, have shown, the average investor's net return is often just the market's return minus expenses. In his chapters on the investment business, Bernstein details how brokerage firms and load funds often prioritize their own profits through commissions and fees. Your protocol here is simple. Seek out low-cost index funds and ETFs that track these broad asset classes, stripping away unnecessary drag on your returns. And finally, a strict 0% of your effort should be spent on market timing or individual stock selection. This is the hardest pill to swallow for many, especially in an era where social media amplifies the rebalancing bonus. In a world obsessed with prediction, timing, and the next big thing, there's a counterintuitive truth that quietly outmaneuvers the most frantic efforts of the market. It's the closest thing to a free lunch in finance, yet it demands the ultimate discipline. Strategic inaction punctuated by systematic re-engagement. We're talking about the rebalancing bonus. This isn't just a quaint suggestion. It's a foundational volatility harvesting protocol. A mechanism to systematically convert market turbulence into tangible returns, acting as your portfolio's autonomous, contrarian intelligence. Think of your investment portfolio not as a static vault, but as a complex ecosystem subject to unpredictable weather patterns. Without intervention, some parts might grow overgrown while others wither. Rebalancing is the gardener, consistently pruning the flourishing and nurturing the wilting. This process, at its core, embodies a contrarian algorithm. It forces you to mechanically sell high, trimming those assets that have swelled beyond their target allocation, and simultaneously buy low, investing in the underperformers whose relative value has diminished. This disciplined countercyclical force automates the very behavior human investors find almost impossible to execute amidst the emotional maelstrom of market euphoria or despair. As William J. Bernstein, in his deep dive into investment mechanics, succinctly puts it, rebalancing forces you to buy low and sell high. The profundity of this strategy is best understood through a powerful real case study. In his analysis, Bernstein cites simulations, often referred to as random walk experiments, which illustrate a remarkable phenomenon. Even in a perfectly random market, where asset price movements are entirely unpredictable, a diversified portfolio that is regularly rebalanced actually produces a higher return than simply letting the individual assets run wild. This is the fabled rebalancing bonus or volatility harvesting. It's the only free lunch in finance. It's not about prescience. It's about systematically exploiting the natural tendency of diverse assets to drift apart and then revert towards their long-term allocations, capturing small gains on the swings. It's the market's inherent churn, methodically converted into ROI. In our current landscape, where AI algorithms drive flash trades, remote work blurs the lines between personal and professional finance, and the attention economy amplifies every crypto surge and meme stock plunge. The human tendency to chase trends or succumb to panic is greater than ever. Your rebalancing protocol acts as a personal firewall. It's an anti-FOMO, anti-FUD mechanism. It allows your portfolio to operate with the cold, hard logic of a machine, immune to the digital noise and emotional contagion that ensnares less disciplined investors. It's your personal hedge against the psychological warfare of modern markets, ensuring you remain anchored to your long-term strategy rather than being tossed by the daily waves of sentiment. Now, let's steelman the strongest argument against this discipline. Many would contend that rebalancing is a foolish act that incurs unnecessary transaction costs and, critically, triggers premature capital gains taxes. Why prune a tree that's still growing vigorously? The intuitive counterargument is to let your winners run. This seems logical on the surface, especially in the context of individual stock picking. However, for a diversified portfolio aiming for risk-adjusted returns, this thinking misses the forest for the trees. The frequency protocol for rebalancing isn't about constant fiddling. The optimal approach, gleaned from historical analysis, suggests a cadence of every 1 to 2 years, or more dynamically, when a particular asset class deviates by 5% or more from its target allocation. This strategic timing balances the desire to capture volatility benefits with the need to minimize frictional costs and tax events. For investors operating within taxable accounts, where capital gains are a real drag on returns, a specialized tax awareness protocol is essential. Instead of merely selling appreciated assets and incurring an immediate tax liability, leverage new contributions. Direct incoming capital, whether from salary, bonuses, or other income streams, towards those asset classes that have underperformed and now represent a smaller portion of your target allocation. This allows you to buy the dip and restore your portfolio's equilibrium using fresh, untaxed funds, effectively rebalancing without realizing gains on your winners. It's a sophisticated maneuver that maintains discipline while optimizing for net profitability. Rebalancing is great, but there is a more advanced technique for the disciplined investor. It's called value averaging. The value averaging protocol. The investment landscape, especially in an era of amplified market signals and rapid technological shifts, often presents a false dichotomy. Either chase fleeting trends or succumb to the slow crawl of broad market participation. But what if there existed a systematic protocol, a deliberate rhythm that not only embraces volatility but leverages it, forcing you to buy low and sell high without the impossible burden of prediction? Enter the value averaging protocol, a sophisticated cousin to the more commonly known dollar cost averaging. Most investors are familiar with dollar cost averaging, or DCA, where a fixed dollar amount is invested at regular intervals, regardless of market conditions. It's the steady, unthinking drip feed into the financial system, designed to minimize the impact of short-term volatility. As Bernstein describes in his discussion of starting investment, DCA, steadily investing a consistent amount regardless of market conditions, is certainly a robust method for building positions over time. However, value averaging, or VA, elevates this discipline. It's not about a fixed contribution but a fixed portfolio value growth target. Imagine a financial thermostat set for your wealth. Instead of simply adding a fixed amount of heating oil each month, DCA, the value averaging system constantly monitors your portfolio's temperature, its total value. If the temperature drops below your programmed growth trajectory, meaning the market is down, the system instructs you to pour in more cash, aggressively buying into the weakness. Conversely, if the market overheats and surges past your target, Often fueled by the FOMO we see in crypto and tech today, the VA protocol demands you invest less, or even sell portions of your appreciated assets to maintain your desired growth path. This isn't merely an academic exercise. Bernstein himself introduces the concept of value averaging through Michael Edelson's strategy, where, by committing to a portfolio value trajectory rather than a contribution trajectory, the investor mathematically forces themselves to be aggressive when the market is cheap, 1974, 2008, and conservative when it is expensive, 1999, 2021. This algorithmic approach is what we call systematic market timing, the good kind. It's not reliant on guessing peaks and troughs. It's a cold, hard mathematical rule to act inversely to market sentiment. It forces precisely the countercyclical behavior that behavioral finance proves most investors struggle with, especially when the attention economy amplifies every market panic and euphoria. Now, one might steelman the argument, saying, but isn't this just another form of active management, a subtle attempt at market timing, which Bernstein so emphatically warns against? It's a fair point. Bernstein, in his broader analysis of investment strategies, cautions against the futility of predicting market movements. Yet, the critical distinction lies in the system. This isn't about making discretionary calls based on gut feelings or media headlines, the very things that lead to misbehavior. This is a pre-committed, rule-based rebalancing, an ironclad protocol that removes emotion from the equation. As he notes when discussing rebalancing, this approach forces you to buy low and sell high, which is precisely the disciplined, long-term behavior necessary for superior returns. It transforms market fluctuations from psychological battlegrounds into predictable, actionable signals. However, a stark warning is necessary. The value averaging protocol is not for the faint of heart. It demands the unblinking discipline to actively pour cash into a crashing market, or conversely, to pare back investments when the market feels invincible and the euphoria. The immortal retiree. Imagine a marathon runner impeccably trained, with a perfect stride. Now imagine that same runner, halfway through the race, suddenly finds the track crumbling beneath their feet, forcing them to navigate treacherous terrain, all while maintaining their pace. This isn't just a race. It's a fight for survival. This is the daunting reality of the immortal retiree in our current economic landscape. In the chapter titled, Will You Have Enough? Bernstein zeroes in on perhaps the most terrifying financial specter for those entering their golden years: sequence of returns risk. He illustrates that a retiree who punched out of the workforce in 1929, at the precipice of a market crash, faced an existential threat to their nest egg. Their capital was obliterated by early withdrawals coupled with plummeting asset values. Compare this to the blissful investor who retired in 1982, catching the tailwind of a multi-decade bull market. The average returns might look similar on paper across a long period, but the sequence of those returns dictates vastly different fates. As Bernstein starkly puts it in his analysis of retirement risks, the worst-case scenario for a retiree is to start out with a long period of poor returns. For decades, the financial gospel has been the 4% rule. Withdraw 4% of your initial portfolio value, adjusted for inflation, and theoretically, your money should last. But this comfortable heuristic, built on historical averages, is now facing its ultimate stress test. In our 2024 to 2025 reality, with persistent low-yield environments, geopolitical uncertainty, and valuations stretched by the liquidity influx of the post-pandemic era, that 4% is looking more like a historical relic than a reliable guide. Consider the unprecedented speed of technological disruption, from AI reshaping labor markets to the volatility of emerging asset classes like crypto. The assumption of steady, robust market growth powering safe withdrawal rates is dangerously fragile. Bernstein implies that in such an environment, prudence dictates adjusting expectations downward, perhaps to a 3% or even lower withdrawal rate, to account for a future that may not mirror the past's golden era. This isn't pessimism, it's realism. The old rules were built for a different economic engine. To combat this sequence risk, the danger of significant portfolio depletion early in retirement, Bernstein advocates a stringent defense strategy. Think of your retirement portfolio not as a single monolithic vault, but as a heavily armored convoy. Your stocks are the valuable cargo, promising high returns over long distances, but vulnerable to ambushes. Your cash and safe bonds are the lead vehicles, the shield wall protecting your convoy's integrity during the most dangerous phases. This is the sequence risk defense protocol. Maintain 2 to 5 years of anticipated living expenses in ultrasafe, liquid assets, short-term bonds, treasury bills, or even cash. This strategic buffer allows you to weather inevitable market downturns without being forced to sell your depreciated stock assets at a loss. It buys you time for recovery. Without this shield wall, a market crash early in retirement can force you into a fatal spiral of selling low, eroding your principal, and condemning you to a premature depletion of wealth. As Bernstein reminds us in the chapter, Will You Have Enough? Retirement essentially is forever. And for forever, you need staying power, not just a good start. Now, a critic might argue, but isn't the point of investing to grow my wealth, not hoard cash? This safe money is just dragging down my overall returns. And they have a strong point. Holding too much cash can indeed be an opportunity cost, sacrificing potential upside during bull runs. However, Bernstein's framework recognizes that while raw, boring is beautiful, the financial landscape of 2024, awash with AI hype, meme stock volatility, and the siren song of quick crypto riches, presents a peculiar paradox. The more one chases the extraordinary, the more likely they are to encounter the profoundly ordinary, or worse, financial ruin. This episode concludes with a summary of the anti-avatar, the alpha hunter. If you think you are smarter than the market, you are the patsy at the poker table. The true winner is the one who accepts the market's wisdom and compounds boringly over decades. This book, then, is emphatically not for the alpha hunter. The core delusion is the belief in one's superior intelligence, especially when it comes to predicting market movements or identifying the next big thing. In this era of information overload and constant notification pings, the lure of the smart investment, the hot tip, or the exclusive pre-IPO opportunity is amplified. One might steelman the argument for active management by pointing to legendary investors like Warren Buffett, whose sustained outperformance seems to defy the very notion of market efficiency. Surely, if they can do it, a skilled individual or a savvy fund manager can too. Bernstein, however, systematically dismantles this notion. In the chapter, The Market is Smarter Than You Are, he highlights Alfred Cowell's III's groundbreaking research, which revealed that stock-picking performance is largely random and successful strategies seldom persist. The consistent costs associated with active management further diminish returns, making passive strategies more appealing. The market, acting as a collective supercomputer processing all available information, is not easily outsmarted. As Bernstein concisely puts it in the final chapter, you are your own worst enemy. It is likely that you are more confident of your ability to pick stocks and mutual fund managers than is realistic. The pursuit of smart often leads to the highest fees and the lowest net returns. It's like trying to outwit a global chess grandmaster in real time, a high-effort, low-probability endeavor with predictable negative ROI. The true ROI comes from accepting the market's wisdom. To navigate this complexity and avoid the pitfalls of self-deception, Bernstein offers a guiding mantra, a foundational framework composed of 4 pillars: theory, history, psychology, and business. Think of this not as mere advice, but as a mental operating system for every investment decision. When faced with a new investment fad, Be it the latest AI-powered crypto or a remote work startup promising unprecedented returns, you run it through this quad filter. Asterisk theory asterisk, does it align with the fundamental relationship between risk and return? Or is it promising high returns with low risk? As Bernstein warns in a final word, risk and return are inextricably enmeshed. Do not expect high returns without frightening risks. And if you desire safety, you must accept low returns. Asterisk history asterisk, has this pattern played out before? In the chapter, Tops, A History of Manias, Bernstein meticulously details how speculative bubbles are cyclical, often repeating once a generation, driven by generational amnesia. Does this new trend bear the hallmarks of past manias? Asterisk psychology asterisk, are your emotions driving this decision? Are you susceptible to the herd mentality, overconfidence, or recency bias which Bernstein dissects in Misbehavior? Is the constant feed of financial news in the attention economy triggering an irrational response? Asterisk business asterisk, who truly profits from this investment vehicle? Is it the investor or the financial institution selling it? As revealed in Your Broker Is Not Your Buddy, and Neither Is Your Mutual Fund? In the chapter on brokers, Bernstein issues a stark warning. Under no circumstances should you have anything to do with a full-service brokerage firm. By applying this rigorous four-pillar protocol, investors can build a resilient financial fortress impervious to the fleeting fads and psychological traps of the modern market. This brings us to the final actionable protocol, the investor's Zen protocol. This three-step algorithm is designed to optimize your financial ROI while minimizing cognitive overhead, particularly vital in our attention-scarce economy. 1. Fire your broker asterisk, as Bernstein details in Your Broker Is Not Your Buddy. The traditional brokerage model is riddled with conflicts of interest. Your broker's incentive is often to generate commissions, not to maximize